Yeah. Good afternoon, investors. Welcome to Money Works for Me webinar. My name is Kushal Jain, and I'll be conducting today's webinar. Today's webinar is actually an extension of our previous webinar, which was on portfolio analysis and portfolio diversification. In this webinar, we'll be actually talking about a new perspective of how one can diversify the portfolio. So that is the topic of this webinar, and uh, as it is clear from the title, this new perspective is inspired by we have been inspired by Peter Lynch's style of investing. So we are going to talk about that. So before we move on to the presentation, uh, I would just like to tell you that you can ask your queries as and when you have them during the webinar. My colleague Mr. Chaitanya Kekre will answer those queries via the chat window, and in the end of the webinar, at the end of the presentation actually, if there are any questions left or if required, I'll be answering the same. So I think we are good to go. So the flow of the presentation looks like this. We'll be just having a small recap of things we discussed in the earlier webinar. So a few things about portfolio diversification, and then again about risk, ability and willingness. We'll be just having a recap of these two points, and then we'll move on to, as I mentioned earlier, uh, a new perspective of portfolio diversification, and depending on that, we have some certain categories of stocks on which the new perspective is based. Yeah, so I'm sure those of you who attended the last webinar are familiar with this slide. So whenever we talk about portfolio diversification, there are certain FAQs, frequently asked questions that we come across. So why to diversify, how much to diversify, which sectors, how many companies, risk, what type of companies. So in the earlier webinar, we dealt with questions like how many sectors, how many companies, what kind of and how much to diversify, large cap, mid cap or small cap stocks. But this webinar essentially will be covering uh, what type of companies one should invest in to for optimal diversification of portfolio. Yeah, so before we jump into the type of companies, I would just like to again have a small recap of what we discussed earlier. So the type of personality you are has an influence on your willingness to take risk, and there is a small free survey which is available on the internet. There are a set of questions which you need to answer. You can just note this link down, and by answering those questions, you'll get a fair idea as to what kind of a personality you are, and accordingly what kind of investment strategies, what kind of portfolio diversification is best for you. So you can just note this link down and have go through this survey. Accordingly, uh, uh, you'll understand as to what kind of risk or what kind of strategies you need to follow, which will depend upon the ability of you taking risk and the willingness of you taking risk. So what we suggest is that if your ability to take risk is low, then you should follow a secure investment strategy, so it will be more risk averse in nature, and therefore no matter what kind of willingness you have, so even if you are willing to take high risk, if your ability is low, it is advisable that you stick to a secure strategy, which means that you'll make safe investments. You won't take risks, and accordingly, if your ability to take risk is high or is medium, accordingly your strategies would vary. So a person who has high ability to take risk follow and accompanied by high willingness to take risk would follow an aggressive strategy, so he'll have more, he's open to take more risks. And for a person with who's medium on both the parameters, he'll follow a more balanced approach of investment. Yeah, so uh, Yeah, so next we come to our main topic today, which is portfolio diversification, another perspective which is actually inspired by legendary investor Mr. Peter Lynch. So what Peter Lynch is of the opinion is that your portfolio, other than diversification into various sectors and various companies and across different market caps, you also need to take into account what type of companies you are investing into. So he has basically clubbed the different sets of companies into groups, which he calls them as stalwarts, slow growers, fast growers, cyclicals, value, turnarounds, question mark. So these are not the categories actually given by Peter Lynch. He had a different perspective. His thoughts were he had written these books, and his thoughts were of the time when investing was of a different kind. Today things have changed, and accordingly, inspired by his categories, we've come with these 7 categories. So we'll just have a look at each of these categories one by one and try to understand what kind of companies fall into these categories and what are the characteristics, and how does it impact your portfolio, and how do we what kind of actions do we take for these type of companies. So we start with stalwarts. So stalwarts are essentially mature companies. They are companies who have been in business for quite a long time, and their special characteristic is that they are consistently growing in nature. So they won't be they won't have high levels of growth rate. They are not fast growers. They won't grow at crazy growth rates, but they'll have medium level of growth rates, which will be close to the industry growth rate. They will definitely not be underperforming the industry. They'll be sticking to the industry, and they'll have growth rates close to the industry growth rates, and plus they'll have a history of good value creation. So these companies are essentially companies who are able to generate good returns on the capital they've employed, and by good value creation I mean the returns that they generate on their capital employed are better than the costs they incur on raising this capital. So such kind of companies, such stalwarts, are generally companies which have good value creation, and it has been observed that generally stalwarts would be one of the top 3 to 4 industry leaders. So a company might be fantastic and might be doing very good, but it won't be called a stalwart unless it has created a dominant position for itself in the industry. So generally for an FMCG company to be a stalwart, it would generally have a high market share, but then there are other characteristics which also need to be present in that company to be called a stalwart. What these stalwarts do is that they play a role of an anchor for your portfolio. So stalwarts essentially will perform in a better fashion during bad times. So during bad times, when things are not good, when other companies and when other companies are not doing well, their growth rates and their value creation parameters are on a downturn, stalwarts would play a role of an anchor, and their cycle will keep on running on, and they'll be doing a good job even during bad times, and therefore they are stalwarts. So some examples would be Ambuja Cements, ITC, TCS. So Ambuja Cement is essentially, as it says, it belongs to the cement sector, which is by default cyclical in nature. The cement sector is cyclical in nature. So it has, we'll come to cyclical stocks and I'll explain that time. But Ambuja Cement, although being a cyclical in nature company, it acts as a stalwart because even during bad times, this company is able to perform well. So typical reasons for Ambuja Cement to be doing well during bad times is that it is the cost control nature of this company is very good. So even during bad times, it is able to control its cost, and therefore it is able to work on good margins. I won't say healthy margins. It would get very good margins during good times, but in bad times, when companies are suffering from bad margins, say 2 to 3%, a company like Ambuja Cements would clock margins like 13 to 15%, and therefore it is a stalwart of the cement industry. Similarly, we have ITC and TCS. So the major reason for TCS being stalwart is that it has been trying to enter into new fields as and when it felt that the IT sector is saturated on a particular point. So at such stages, TCS tried to get into new things, and therefore it has able to have characteristics of stalwart companies. So it has managed to consistently grow and create consistently good value. In ITC's case, it is a stalwart because although it has been able to create good brands across the years. So the tobacco industry, although it is competitive in nature, but brands that ITC has are far above than the competitors, and therefore the ITC was able to generate value and was able to clock good levels of growth rates across the years, and therefore these kind of companies are stalwarts. So essentially stalwarts would would provide a security to your portfolio. So even during bad times when other type of companies are not doing well, stalwarts would ideally not be falling. They'll give a security to your portfolio. Next we have is a category called slow growers. So slow growers again are mature companies. They are also companies which have been into business for quite a few number of years. They are also large companies, but they have somewhere lost their way because they haven't been able to innovate, or they haven't been able to bring in new products. So because of such things, you will observe that companies which are slow growers would generally have declining rate of growth. So although they are mature companies, although they have been able to create value across the years, recent years will show that these companies are not growing at growth rates they used to grow earlier. Plus they've been creating value in the past, but now because of stagnating situation they are not able to create value. They are able to create value, but the intensity with which they were creating value in the earlier years is lost somewhere, and they are on a more stable to declining trend if you observe the current situation. So major reason for this, one is, as I mentioned earlier, they are not coming up with new things. So they are not coming up with new products. Also, when there is little scope for expansion, the expectation of growth in the future is also not quite good. So these kind of companies we generally have little scope of expansion. But then since they've been creating value across the years, since they've been growing at high growth rates in the earlier years, these companies are cash rich companies. They have they are cash rich companies, and therefore they'll be paying high dividend to you. And therefore they'll be paying high dividend to you. That is because since there's little scope for expansion, they have money but no room for expansion, no room for investment, and therefore they idly distribute the cash to their shareholders. Typical examples of these companies would be Infosys, Reliance Industries, and HUL. HUL is a slow grow is expected to be a slow grower going forward, is because it is a big leader in many of its segments, and there is no room for further expansion in those segments, and therefore only thing that HUL that there is only hope with HUL is that it will grow slowly now, because there is no expansion of there is no room for further expansion for these companies. Similarly for Infosys, if we compare to TCS, it hasn't tried new things later on. So it is basically into application development. It develops applications and then tries to find out a market for these applications. But the IT sector has moved on to new things. They are trying to be more customer centric now, which Infosys has failed to do, and therefore we feel that Infosys going forward will be a slow growth company. Although it has created good value, it is cash rich, but from the growth perspective, this company is expected to be a slow grower going ahead. Reliance Industries Limited, again a huge balance of cash on its balance sheet, but no room for investment left. So it has been criticized for quite a long time that it has huge cash, but it is not making the correct investments. It is not actually using that cash for anything. So that is why RIL would be a slow grower. So the characteristic of these type of companies is that you cannot expect high capital appreciation from these companies, but since they are cash rich, they've done well in the past. These are companies which should pay you high dividend. So these kind of companies, generally risk averse people would have in their portfolio, mainly for the dividend benefits that these companies give. Now next we move on to fast grower companies. Fast grower companies would generally be small and medium scale companies. They are expected to grow at high rates, and therefore they are in the grower category. A crucial an essential point for these type of companies is that there should be an existence of a big market. Only if there is a big market available, there can these companies sell their products and and be fast growers in the future. It is the fast growth that will create value for these companies. So in the initial years, their value creation might be subdued in nature because they have to pump in a lot of money, which might not start generating returns immediately. It will take some time. So they might have subdued value creation in the earlier in the initial number of years, but then they are expected to grow fast. But the primary criteria is that there should be an existence of a big market. If Another thing is that niche innovative companies who create a market for themselves, who not there might not be an existing market available there, but they create a market for themselves. Such kind of companies are also they also have the benefit of a low base, which helps them to clock higher growth rates. But essentially, it's the niche and the innovative nature of these companies which make them fast growers. They try to operate in untouched markets or in markets not thought of earlier. So typical examples here would be a company like Jubilant Foodworks. Jubilant Foodworks, the Domino's pizza chain is run by Jubilant Foodworks. So no one ever thought of uh, delivering pizza like the way Domino's did. So they were a market leader into the pizza delivery kind of a business model, and that helped this company to clock very good growth rates. Cognizant, like I mentioned earlier, they were developing more customer centric systems which help them to clock good growth rates. In case of Power Grid, although a big company, in the current situation itself, it is expected to be a fast grower primarily because it is said that, in fact, it's a fact that India is highly underinvested if the transmission part of the investments are concerned. So it is ideally said that if 1 rupee is invested in, say, generation of power, another rupee should be invested in transmission of power, because then there needs to be transmission assets for sending the power to wherever it is required. But in India, what has happened is, for every rupee invested in generation, we've been able to invest just half a rupee, 50 paisa in transmission, and therefore the scope for expansion for a company like Power Grid is high. So we require new transmission lines. We are developing on the generation side of the business, but transmission we are still lagging behind, and therefore there is existence of a big market, and there is scope for setting up of new transmission lines, and hence we feel that Power Grid is going to be a fast grower in the coming years. Yeah. Next, we have our cyclical companies. Now, cyclical companies are generally affected by economic cycles or by specific business and industry cycles. So, economic cycles would generally be rate sensitive sectors would be impacted by economic cycles. So, when the economy is going good, when interest rates are low, rate sensitive sectors like capital goods, infra companies would tend to do well because because of the low interest rates, they have the incentive of taking up money and starting new projects. When the cycle is down, when the economy is not doing good, the RBI and the government would try to control the inflow, the pumping in of money, and at such times companies like BHEL won't do well because there is not enough incentive for them to take up new projects. These kind of companies, capital goods and infra companies, are affected by economic cycles. Then we have other companies which have their own industry and their own business cycles. So a sugar company is a typical example of a company who has its own business cycle. So in years when the in years when sugarcane manufacturing is in a downturn, people are not manufacturing enough sugar, there will be shortage of sugarcane, there will be shortage of sugar, and the prices of sugar will soar. So those who are selling sugar would benefit. They would try to get into business as much as possible. but then when the cycle turns, when sugarcane production falls, the things would turn upside down and sugar rates would fall, and the sugar companies won't do well. So sugar companies have their own cycle, and companies like NMDC, they follow the commodity cycle. So their growth rates and their value creation parameters would be more dependent on the commodity prices that are going on. So there will be a cycle in the commodity prices, and depending on the cycle, whether it's a boom or it's in a downturn, NMDC companies like NMDC would have their growth and value creation parameters working accordingly. Next category we have is value. These are companies who have certain hidden assets, and these assets are not essentially appreciated by the market. So could be a land bank, could be high amount of cash, could be some kind of patents that the company possesses. These assets, if not appreciated by the markets, these companies trade at very low valuations, and if one is able to catch this and enter into these companies, they could turn out to be multi-baggers for you. But it is important that you identify these companies well. So such kind of companies, generally the replacement cost of assets of such companies will be more than their market cap and debt, which is why they are available at a good valuation. A crude way of identifying such companies would be companies which are trading at a P by BV ratio of less than 1, which means that the market is not pricing even the net worth of the company. So which essentially means that if the company today goes out and sells everything, it will earn more than what the market is currently giving it. But it's a very crude way of identifying companies, because there are a lot of other factors that go into such companies, because when we are looking at the book value, are we looking at the current book value? Is the net worth what the company is going to get when it goes out in the market and sells it? So B by BV ratio is a kind of filter to identify such companies, but not the whole and sole factor you should consider while identifying value companies. Here, for such kind of companies, will probably need to have some kind of industry knowledge, that the land that the company possesses, is it going to be able to make good use of it? If it has lots of cash, then what are its plans of making efficient utilization of the cash? Examples for this company is a company like Neyveli Lignite. Neyveli Lignite of late has been beaten down. Primarily we feel it is because of the agitations that this company, the labor unions of this company had, because of the stake sale they were supposed to do. But it is running at a P by BV ratio of less than 1 currently. We feel that it's a good power company. It should sorry, it should do well in the future, and therefore we feel that Neyveli Lignite is a value buy. The oil marketing companies HPCL, BPCL are also value companies, but we will discuss about them in the further part of the presentation. The next category are our turnaround companies. Turnaround companies are totally beaten down companies. They have very poor growth and value creation parameters. Some of them are loss making in nature, but we'll call such companies turnaround companies only when we expect these companies to make some kind of a comeback. So this comeback could be because of drastic changes in the management, or drastic changes in the strategy, or because of restructuring happening in the company operations. When there are such signs of revival, one could look at turnaround companies for investment. And a typical example of this is Wockhardt. Then we have a category called question marks. So question marks are essentially companies which were very good in the past, but they have somewhere lost or are losing their way. So these could be slow growers or fast growers who have not made good investments in their good times. So these companies could turn out to be question marks later. So they may have good growth, they might be growing at good growth rates, but then they are not making efficient utilization of the capital they've raised. So as a result, they have poor value creation, and they because of some or the other thing, they have an uncertain future. For example, Tata Steel was a good company earlier. It was doing good, but with over ambitious acquisitions like that of Chorus. It had a lot of pension liabilities on its books, and since then it has totally lost its way. And we feel that this company has an uncertain future, and therefore things are not very good for these companies, and so it's a question mark. Similarly, we have Tata Power. Tata Power is also a good company, but it bid for a power project, an ultra mega power project at very low rates. Then things did not turn out well with the coal prices. It had to import coal at a higher rate than it was contracted earlier because of an Indonesian policy change. So not essentially, it's open to debate. Not essentially a fault of Tata Power, but it is because of it's such an important project. It is losing its way, and therefore there are, you can say, question marks over this company. Other examples are Larsen and Toubro, Escort. Larsen and Toubro essentially because it was a good company earlier, like all question marks probably are, but then it went into over diversification. It went into insurance, an engineering company entering into insurance. Then it has applied for the banking license as well. So such over diversification did not work out pretty well for L&T, and therefore it is a question mark right now. Yeah, so these were the characteristics of the seven categories that we feel one should also look at while looking at their portfolio. Issues with all the companies, we'll discuss the issues with these categories. Now, stalwarts. Like I said, they are mature companies. So are slow growers, and stalwarts, if they're not able to innovate, if they're not able to bring in new products in the market, they could soon become slow growers. So that is how the cycle follows. So a product life cycle or a company life cycle will essentially be, it starts off, it's in a hyper growth phase, then it becomes mature, it becomes a stalwart, and if it is not able to sustain the kind of things it has been doing in the past, it will slowly become a slow grower. It is not a bad company, but it is not being able to clock better growth rates now, and therefore it could become a slow grower earlier. So that is the kind of thing we need to watch out for. Slow grower, like I mentioned earlier, our cash rich companies should essentially be paying high dividend. So a signal, so if a slow grower is not paying you adequate amount of dividend, it means that you take it with a pinch of salt, and safely assume that this kind of company is misusing cash. So it is very essential for a slow grower to be making good dividend payments to you, because this is the whole and sole reason for a person to invest in these companies. We do not expect this company to give you good benefits via capital appreciation, but it should definitely pay you good dividends. Then we have fast growers. Fast growers are companies, are ambitious companies who are looking to have multiple level of growth rates, and that desire of high growth rate could lead to malinvestments. So such kind of companies could go for hasty acquisitions, and lose their way. So Tata Steel is an example. So it was doing well, it went on to buy Chorus at very high valuations, and since then we've seen is that it has not able to perform quite well. It has not made a comeback. So fast growers, we need to be careful, because such companies, in the pursuit of high growth, they make hasty decisions. Another factor is that such kind of companies also attract growth. So a fast grower who's in a niche category, or has developed a new product, will rule the market earlier. He'll have the first mover advantage. He'll be selling a lot. He'll be doing very good. But then it attracts competition. That is how business works. So there is someone new starting, and people catch up. So as and when competition catches up, as and when new players enter in the market, the fast grower loses the advantage it had earlier, and therefore the question we need to ask is that, can it sustain that high level of growth? So it will depend on how it manages to deal with the competition, and will it be able to innovate more, and bring in more products, so that it can move on a fast growth in future as well. So that is, we need to question that, can it sustain this high level of growth? Then we have cyclical companies. Now cyclical companies, timing is crucial in a cyclical company. If you identify a cyclical company at the bottom of the cycle, you'll end up making good investment. But then you need to look. You also need to check that is a cyclical is the cyclical company you are looking at, is it highly levered or it is not levered. So by highly levered, I mean has it taken up a lot of debt for its operations or not. So the problem is that highly levered cyclical company would not have the strength to catch opportunities. So when a company has a lot of debt on its books, even during bad times when things are not good, when it can make investments at cheaper rates, the fact that it is highly leveraged, it is not able to do so. Whereas a low levered company who does not have debt can take advantage of the situation of a down cycle. So in a down cycle, when things are available for cheap, when projects could be, when interest rate is not that high, a company who is not levered that much, who does not have too much debt on its books, can make good investments in the down cycle and can reap benefits when the cycle is in the upturn. But a highly levered company might not be able to sustain even during good times, and therefore we need to check for debt parameters for cyclical companies. The issues with companies of the category value is that we need to check, is the value actually realizable. So a company might have hordes of cash with it, it might have a huge land bank, but that if the land is on lease, it is actually not the company's land, and it might not be ever able to realize value out of the land. Similarly, if it has a lot of patents, but the patents might be huge in number, but quality wise the patent might not make much sense, it might not be able to unlock too much value out of the patent. So huge number of patents the company has, you might feel it's a value buy, but might not turn out that way. So in case of, if the company has hordes of cash, can it make good investments with that cash? Can it make investments so that in future it will be able to create good value for its shareholders? So is the value realizable is the crucial question we need to ask. And even if it has these kind of assets, will the market ever appreciate the hidden value? Now that is a question which nobody can answer actually. But if the market hasn't been able to value it till now, will it value in the future, is kind of a gamble we need to run on. Then we have turnaround companies. Now, like I mentioned earlier, for identifying turnaround companies, you need to check if a beaten down company, if company with poor financials, are there some signs of revival in it. So various ways of identifying this is that gradually across the few quarters, or for the past 1-2 years, the company is turning into profits, or if it was into profits, it is clocking good margin growth rates, good margins. It had huge inventory levels earlier, these inventory levels are falling. So these are typical signs of a turnaround company. But no, not essential, it is not essential that the turnaround will actually happen. So the sign of revival could be just a false alarm. And then if you invest in such companies, if things turn out bad in the near future, then these companies could again be a loss making venture. Therefore we need to be careful. Also there could be a bias of hype. So what we often feel is that a company who is beaten down, we feel it is so beaten down now that there is no further scope of things going wrong for this company. And then the common perception is that this company will start doing well now, but it is not necessary. It could still fall down, and therefore we need to be careful. We need to keep emotions aside when we are looking at turnarounds. In case of question mark, the typical question is, can they find a way out? These are companies which were good in the past, but have lost their way. So can they find a way out of the ruckus they're into currently? Yeah. So what you need to look out for uh, in case of a fast growth company, uh, it is advisable and it is logical that you enter when the company is an expansion phase. So in the product in the life cycle of a company, when a company starts operating in the market, it is in a growth phase in the earlier part, but it is still in an establishment phase. So once it establishes itself, is a time when it starts clocking hyper growth rates. So we not need to enter in such companies at the bottom when it starts, but when it has established itself and it is in an hyper growth phase from then on. But then, as I mentioned earlier, we need to check that in the pursuit of high growth, is it making over ambitious acquisitions. These over ambitious acquisitions could lead to a downfall of the company. And then such companies we need to exit when many players start entering the arena. So like I mentioned, a fast grower, if it is growing fast, if it is clocking good growth rates, other players, other companies will be attracted to enter the segment that the company is operating in. And such entering such competition could then lead to the fast grower losing its advantage and becoming a normal company. But what we need to remember here is that if the market is big enough to accommodate many players, then it is probably good for the fast grower. So a fast grower starts, there are 2-3 companies joining in, it will actually stabilize the market, it actually give good benefits to the fast grower. But when many players enter, when there are other players, there are huge number of players entering, is when the market, the industry becomes hyper competitive and the fast grower loses advantage. So this is a typical example here would be telecom. So when there were just couple, or there were just 3-4 players, things were good, they were able to charge good tariff rates, they were able to have good growth rates, and they were able to create value. But it was when there were hordes of companies, there were other 10 to 12 telecom players entered in the market, and things became good for the consumers. They were able to reap in benefits of absolutely low tariff rates, but it was not good for the company. The companies had to, because of the hyper competition, their ARPUs kept on going down, and companies which were doing very well, the incumbents like Bharti Airtel and Vodafone, which were doing very well in the past, could not keep up their earlier growth rates because of hyper competition. There were many other players who entered the market, and therefore the telecom market as a whole could not remain a fast grower. So companies which were earlier clocking very good growth rates could not do so when the situation became hyper competitive. In case of cyclical, it is easy to say that cyclical company, we need to catch it at the bottom and then we'll make huge gains, but it's not easy to catch a cyclical company at the bottom. We need to look for signs of recovery of a fall. So you could be entering a cyclical company when it is at its peak and it's going to fall from there. So we need to look for signs of recovery. So even in this case, margin improvement, lower levels of inventory are typical signs one looks for in a cyclical company to invest or not. So rate sensitive sectors which are more dependent on the economic cycles would look for what kind of interest rates are prevalent in the company. Fall in the interest rates means that the capital cycle is going to pick up, and then capital goods companies like BHEL should do well. So for companies that are dependent on economic cycles, they'll have to look at macro factors, whereas those who have specific industry cycles need to look accordingly. And another thing is that, like I mentioned earlier, the importance of leverage in a cyclical company. So there's no harm in mistiming a low levered cyclical company. So even if a company has low debt, a company has a low debt, and even if you invest in that company at a higher level, you won't lose out much because it will do well in the future. But a high debt company, even if you catch it at the bottommost point, it is not essential that this company will grow, because it might not be able to make proper investments because of the high leverage nature of the company, and therefore there is no harm in a little mistiming for a low levered cyclical company. For a turnaround company, one needs to invest only when there are sure signs of improvement. So this also will require some kind of industry knowledge. So if there is a change in strategy and a change in management, these factors by themselves do not tell us that this company is now going to make a comeback and will perform well. only if we understand that the changes that the company is making, is it going to benefit the company, can we say that this company is going to turn around. And therefore what we say is that do not hesitate to exit if situation worsens. So like I mentioned earlier, signs of improvement could be a false alarm. So there could be a couple of quarters or three or four quarters where the company has done well, and then again it might start showing its earlier colors. And therefore even if then if you observe such parameters, such financial parameters not doing well for the company, there is no need to be patient in that case. You should definitely exit as soon as the situation worsens. In case of value, you need to verify the value. The company has huge land bank, but then is it the company's land or is it on lease? So verification of value is essential. Then another crucial thing is that we need to check for the corporate governance practices of the company. The company might be a good value buy. It might have assets which are not appreciated by the market, but when things turn good, it could be the promoters and the management of the companies who reap in the benefits, and the shareholders are left with nothing. Therefore, a company, although if it has good value, if it's a good value buy, we need to check if the management is good enough to be able to share the benefits from unlocking of the value with the shareholders. If it is not so, then a value buy is not actually a value buy. It is not worth investing. And final thing is that a value would actually take a very long time to unlock value. So it might take 8 to 10 years for value to be unlocked, and therefore only if these value buys are able to give you returns like 50 times, 100 times, or 150 times, is it advisable to invest in these companies. Double the return in say 10-12 years is not a return actually, and therefore that won't be a value buy. It should give you huge returns, because the time frame of investment is very long in case of value companies. Yeah, so now that we have looked at the issues and the characteristics of these companies, we have a metric in front of us here, wherein we've compared, wherein we've taken into account the risk and importance of valuation across these categories. So what essentially this metric means is that how much does valuation matter for a particular set of companies, and what is the risk and the volatility of price of these companies. So a stalwart is a very good company. The risk and volatility is low, and valuation does not matter much, and therefore the positioning of a stalwart is on the right top hand corner. Whereas in case of a turnaround, things change very fast. Anything could happen, and therefore the risk and volatility is high. Valuation matters a lot, because you cannot invest in a turnaround when it is at high valuations. You need to invest in turnarounds only when it is at low valuations, and therefore valuation for turnaround companies matters a lot. Similar is the case with cyclicals also, since they move through cycles, the risk and volatility is high, and valuation matters very much, because we have to catch these cyclicals when they are at the bottommost, and therefore valuation matters a lot. In case of value companies also, valuation matters, because we want to invest them when they are available at dirt cheap prices. They won't be that volatile, but we need to enter it at very good prices. Fast grower would lie somewhere in the middle of the park. Their valuation would matter. It would definitely matter, because we need to enter at a time when the company is established and on the verge of having hyper growth rates, and therefore valuation will matter for these kind of companies. In case of slow growers, like I said, the risk and volatility is definitely low, and we do not expect too much of capital appreciation, but then valuation does not matter much. It matters a little, and therefore the location, the positioning of this company is like this. Yeah. Now we come to the allocation for these kind of companies. How will you allocate your equity portfolio for these categories? So if a person is aggressive in nature, which means essentially he needs to have high ability to take risk and high and willingness to take risk as well. This such kind of a person would invest, would then be open to investing in fast growth companies. He won't be, by growth here, major part of investment will be in fast growth companies, and a small part could be uh, uh, in slow growth companies. He would definitely invest in stalwarts. Although he's an aggressive fellow, he is open to take risk, but stalwarts would give stability to his portfolio. Even when the others are not doing well, stalwarts will give him some benefits, and therefore a small part of his portfolio, a significant part, say 20% of his portfolio, should be in stalwarts. And since he's open to take risk, he will invest in turnarounds and cyclicals also, and value also, and the division would be say 10%, 20 and 20% respectively. So an aggressive person would somewhat have would somewhat who somewhat should have this kind of portfolio. Moving on to a conservative, a more risk averse investor would have majority of his investment into stalwarts. He does not want high growth. He does not want very exceptional kind of returns. He just wants to beat the market. So he will stay in stalwarts. He wants stability to his portfolios. He is not looking out for unpleasant surprises, and therefore he'll have major investment in stalwarts. He could have say around 20% of investment in growth, but then majority of his investments would be in slow growth companies, because he is looking for dividends out of these companies, and a little investment in value and cyclical companies. The question marks and turnarounds, such kind of a person will obviously not be investing in these companies, because he is of a conservative style and does not want to risk his money. Balanced kind of a person who has medium level of risk, who is willing to take medium level of risk, and the ability is also to take medium level of risks, would have a portfolio more or less divided equally between stalwarts, growth and value companies. He'll have a little investment in cyclical companies, but then again, just like conservative, will stay away from the turnarounds and the question marks. We are almost at the end of the presentation. So few things to conclude are that stalwarts are consistent performers and act as anchor even during bad times. Like I mentioned earlier, even during recessionary times, the stalwarts won't be performing badly. Their performance would be good, and therefore they will be an anchor to your portfolio. But then again, you should not have crazy return expectations from stalwarts. Stalwarts can't be multi-baggers. They won't give you double the return. Maximum CAGR returns that you can expect from these companies across a long period is 13% to 15%. But then they give stability to your portfolio. If you want high returns, if you want very high returns, you could invest in cyclicals and stocks that offer value, but then the risk is very high here. Trick is, like I mentioned earlier, catching them at low commonsensical valuations. If you are able to catch these companies at low valuations, you'll end up getting higher returns. But then the risk is high, because catching the company at low valuations is not the easiest thing to do. And if you want multi-baggers, then turnarounds and fast growers are the best bet for you. But yeah, the risk is absolutely very high. Early entry matters, or it could become fairly or overvalued within a short period of time. So you might feel that a company, a turnaround is worth investing, or a fast growth is worth investing. But if you not enter at the right time, the market could have already valued it at valuations, assuming that these companies are going to be turnarounds and fast growers. And if you enter at a later stage, you've probably lost a lot of opportunity already. In case of cyclicals, timing of investment is absolutely crucial. You have to catch them at the bottom. Over allocation in cyclicals is not advisable, as emotions could lead to hasty decisions. So what I mean by this is that in your portfolio, you could have various sectors. You are well diversified across sectors. You have ideal diversification as far as sector allocation goes. But then across the sectors, if you have a lot of cyclical companies there, so if you have a few cyclical banks, a few capital goods, automobile companies, it is not advisable to have too many cyclicals in your company, in your portfolio. That is primarily because emotions could take a toll then. So a cyclical company won't always go in your favor. So you feel that you've invested in a cyclical company at the bottommost point, but but the market says that it still needs to fall down further. It falls down, and then it might raise and give you huge value in the future. If you have a few cyclicals in your portfolio, you could be patient, and you could be and even on falls, even on price falls after investment, you could be patient, and you could manage to wait, and then gain returns in the future. But you have many cyclicals, all of them are falling at the same time. Emotions will take a toll on you, and you'll end up selling these companies at a loss. And therefore, although a good sectoral diversification in your portfolio, you should not have many cyclicals. This is just so that emotions do not lead to bad decisions. Like I mentioned about fast growers earlier, uh, in pursuit of high growth, these companies might end up making malinvestments, and therefore you need to watch out that if you have invested in these fast growers, are they doing what they've done historically, or are they now going for over ambitious projects and over ambitious acquisitions? Such are signs that these companies might be losing their way. Then it is not easy to identify potential turnaround companies. Like I said, the small improvement in performance that these companies clock might be just a false alarm. They could be falling again, and therefore it is not easy to identify them. And finally, what I can say is that a stock does not stay in the same category forever. uh, Things will, the stock will keep on moving. So a stalwart might become a slow grower. Slow growers and fast growers who are not doing very well, who are not making good investments, might turn into question marks soon enough. And therefore a stock won't always stay in the same category. It will move. Yeah, so that is the end of the presentation actually. uh, what we are going to do on our website is that we are going to categorize the companies from our coverage universe across these categories. So we will uh, give a particular company a category depending upon the characteristics and depending upon the factors that I have just discussed. So in the initial part, we have done this for our top 100 companies. Currently we have it for 90 companies, and going ahead we'll have these categories for our entire coverage universe of say around 300 companies. So this is into implementation phase. I will just like to show you how it will look once it is implemented. So say Ambuja Cement, it's a stalwart company. So in the decision maker of Money Works For Me, you'll be able to see what kind of a particular company, what kind of a category a particular company falls in. So Ambuja Cement is a stalwart. Similarly, a slow grower would be looking like this. Then Power Grid Corporation, as I mentioned earlier, is expected to be a fast grower, and therefore a screenshot of how this will look once these categories are implemented. Then we have cyclical, value, and question marks. So these are just screenshots of how these categories would look once we implement them. Yeah, so I believe Chaitanya has answered a lot of your queries. So let's just check if, yeah, so if you have any other queries, you can go ahead, and we can accordingly answer them. Yeah, Mr. Ramchandra, as I mentioned, once this feature is implemented on our website, we have already categorized around 90 companies, and the categories will soon be visible on the decision maker in say about a week's time or so. Yeah, like I mentioned, it should take another. Yeah, so I believe there are no further questions. So thank you for your patient listening, and uh, we will see you in the next webinar. Thanks a lot.